Okay, so let's take a read at the question. All right, so we have, I think for the sake of reading the question, let me just expand this. All right. Okay, so on April 2009, Picant acquired 75% of Sanders equity share in a share-for-share exchange for 3 shares in Picant for 2 shares held in Sander. All right, so this is a for every 2, they'll give 3. So that is the meaning. The market price of Picant share is at the date of acquisition. So you have this and you have this, respectively. So Picant own is this, and Sanders own is this. I hope you know which one to use for your purchase consideration. All right. In addition to this, Picant agreed a further a further amount on April 10th. So that one is like 1 year ahead. That was contingent upon the post-acquisition performance. At the date of acquisition, so this one is what we call contingent consideration. And it says that at the date of acquisition, they assess the fair value of the contingency to be 4.2. And by the end of the year, it was clear that the amount will be what? 2.7. The question says ignore what? Discounting. All right, so that's that. Picant has recorded the share-for-share exchange and has provided for the initial estimate of the 4.2 for the contingent consideration. So it means that it has been done. All right, so you don't need to worry yourself about doing it anymore. It has already been done, but you need to still select the figures for your purchase consideration to be able to calculate your goodwill. All right, please, any question at this point? This introductory part, any question at this point? Okay, so in the absence of question, let's continue our reading. Guys, hold on. Let me check. I think my laptop not in charge and go off. I think it's on charge now. All right. So that is what we have. Then it says that on October 2009, Picant also acquired 40% of the equity share of Atla, paying 4 cedis in cash per acquired shares and issuing at par 107% loan note for every 50 shares acquired in Adler. So this is an associate, all right? This consideration has also been recorded. So it has been recorded. So it means that you don't need to do any double entry in the SOFP. All right, everything is already there. So when you go there, you just record it as you see it in the trial balance that they will give you. All right, it sometimes serves as a check because like the share for share exchange, this one means that you should see a share premium in the trial balance, okay, to be able to help you know that that is what you're going to use. I don't know, something is wrong with my battery. Guys, just a moment. All right, so they have no other investment. This also means that any other thing that you see in the trial balance or the SOFP will represent the investment that they have in the associate. And this is the SOFP. So you have for this, you have your assets, on current assets. All right. So this is what you have. You have your inventory, trade payable, total assets, equity shares, 1 Ghana cedi each. So the share premium. So this was what I was talking about. It is already there. All right. Retained earnings at 2009 is what you see. And for the year ended 31st March 2010, this is what you see. All right. Then you have your 7% loan note, which they spoke about, which is also what you see. Then you have contingent consideration, and this is also what they talked about as being recorded. Okay, so you see that everything is being recorded, and you have total equity. Now you have some notes to deal with. Okay, you have just 5, of which one is useless. This one is useless. All right, so it says that at the date of acquisition, the fair value of Sanders PPE was equal to the carrying amount, with the exception of Sanders factory, which had a fair value of 2 million above their carrying amount. This one is above, so you know what to do. Sander has adjusted the carrying amount of the factory as a result of the fair value, has not done it as a result of the fair value exercise. This requires additional annual depreciation of 100,000 in the consolidated statement of financial statement in the post-acquisition period. Also at that date, Sander had an intangible asset for software in its financial statement. Picant directors believe that the software has no recoverable value as at the date of acquisition, and Sander wrote it up shortly after acquisition, its acquisition. Yeah, so that is those things I explained yesterday. Okay. All right. So as at 31st March 2010, the current account of Sander was 3.4 debit. It did not agree with the equivalent balance in Sanders books due to goods in transit. This one is goods in transit. Okay, goods in transit. All right, by Picant on 28 March 2010, but had not been received by Sander until after the year end. Picant sold all these goods at a cost plus at 50%. Well, we will see what to do about it. Then we have, it is the policy of them to value NCI at fair value at acquisition. For the purpose of this, the share price at that date was deemed representative of the value of the shares that were held by the NCI. Impairments were carried out, and the value of investment in Adler was not impaired. So this is the associate, but due to poor performance, consolidated goodwill was impaired by 3.8. So that's that. Then you assume this. All right. So this is what we are going to do. We will ignore the B part of the question for now, because those things are not really asked in your case. All right. So we're going to start to deal with this. All right, so let's move. So at least you should be able to determine your group structure, right? So let's do the group structure. Workings 1. The question is requesting that we do SOFP only. So we have workings 1. Group structure. All right. So the group structure, we have Picant, and we have who? Sander, right? And the percentage is what? Guys, you can unmute. Let's do this together.
75%.
It's what?
75%.
Yeah, 75%. And the acquisition date is what? 1st April, as you can see here. I told you that immediately you see this, go and check the reporting question comment date. It is March, so it is full year. All right, so full year. Then there is an associate called Adler. And for the associate, it is 40%, right? And the purchase was in October. So October to 2009 to what do you call it? March 2010 will be how many months?
6 months.
6 months.
All right. Sorry. Okay, so you see this one, there is an associate, so your workings number has to increase, right? It has to increase to like 6 or 7. Normally it's 6, or depending on how you want to go by it. So your fair value of net assets of SAP. I told you, see, if you are in the exam hall and you feel like, hey, there is an associate, I don't know what to do, please pretend as if there is no associate para, all right? If you don't know how to go around the associate, just pretend that it doesn't exist. Do the normal subsidiary that you know. You get your pass mark. All right. So at reporting post-arc, stated capital let's go to see the equity side. Stated capital for this one is 8,000, right? So 8,000. Who can tell me the retained earnings? Yes, at acquisition.
16,500.
16,500.
Okay, no, it's 1,000. It's
1,000 at reporting.
1,000 at reporting.
Yes.
Yeah, 1,000.
Yes, any other person?
No. At acquisition is 16,500, and then the profit for the year is the 1,000.
Okay. So what does that mean?
So post-acquisition is 15,500.
No. So you see, these are the things that beat you guys in the exam. So retained earnings as at this date is 16,500. And this is the date they bought the company. So that will be what? The acquisition.
Yes.
But the post is the one that they had plus the profit for the current year. Have you forgotten what we did yesterday?
Yeah, so then that will be 17,500.
Of course. Have you guys forgotten what we did yesterday so soon? Please be careful.
Okay.
Yesterday's question, I think, is here. So it's the same thing. You see, yesterday you had your equity structure, retained earnings to be this post-acquisition, right? At reporting. This is at reporting. And you realize that they gave you a different P&L. So there are ways that these questions come by. The easiest way is for them to give it to you in the notes. But please don't just get this thing wrong because you are not giving it in the notes. So yesterday you realized that this is the at reporting. then you came to find out this one is the profit for the year. It's the same way they have quoted it. And this one we had to divide and start from the end to get to here. Because we were given the post, that is what happened. Sorry, this is the retained earnings part. This is it. Okay, so please be very, very careful how they present these things for you. Understand what you are doing. All right, so if it is this is retained earnings up to this date, so that is the date they acquired it, then the profit for the year ended is also this. So at reporting will be this one plus this, and this 1,000 that you see will now be your post what acquisition. You see the difference? So please be very, very careful. Be very careful on that. Yes, any other thing?
Fair value adjustment.
Fair value adjustment. That is for this 2 million. So you do fair value adjustment of 2 million. Please let me hereby put 0 zeros. 2 million. Then the subsequent measurement, this thing will suffer depreciation, and they told us that the depreciation adjustment was how much? 100,000, right? 100,000. Yes, what else? Don't forget, they also told us that acquisition, they have some intangible asset, which is 500, which they believe that it has no recoverable value. And so at the date of acquisition and should be written off. So intangible write-off, all these things, you have it in your book. So you write off the 500. And at the reporting date, it should not exist. Okay. So that is what you go through. You write it off. It's also like the fair value adjustment, but just in this case, we are writing it off. All right. So that is that. Please, any question? Yeah, so far, and I think I saw some intra-group trading. Who sold to who? This is it. And this one is a current account problem. Oh, okay. So there is no PAPs at all.
No.
Oh, all right. So please do the addition for us fast.
At acquisition is 26,000.
Okay. So give me all the 2,000. So you have 26,000.
26,900.
26,900. And
900.
All right. So working straight. Good work. All right. So let's look at the purchase consideration. I think that one was the beginning of the whole story. All right. So please let me give you guys 5 minutes. Work it out. And try your hands. Work it out. 5 minutes. So exactly 6:32.
That's why you are so dangerous. Because God has given you the power to do something and give you life. Make you freedom. 25 years to pick this up. That's why a woman has a woman. That's why when I'm actually calling you, man, I think you did it. Rich means you receive, you multiply, you give.
Hey, what is going on here? All right. So purchase consideration. There's a share for share exchange, right? And so what do you do when there's a share for share exchange? Number of S shares acquired. How much is that? 75% of how much? 8,000, right?
Yeah.
Yeah, that would be
6,000.
It's what?
6,000 shares.
6,000 shares. All right. Then you have number of parent share issue. We are getting, it was how much? For every
6,000 divided by 2
6,000 over 2
times 3.
by 3. And how much did you get? That should
9,000.
be 9,000 shares. Then what is the value of the parent share? There were 2 prices. Which one did you use?
They're 3.2.
Of course. So it will be 3.2. So 3.2, you do 9,000. Can do 9,000 by 1, which is the share. You get what? 9,000. And if you want to verify your share premium, you also do 9,000 by what? 2.2, right?
Yes.
The 2 will give you the 3.2. How much would that get you? 19,800.
800.
So just to confirm, since they told you it has been recorded, when you come here, you see that is what is here. That is what it means it has been recorded. So you don't have to add it when you are doing your balance sheet. All right. So you just pick what is here. All right. In your balance sheet. You don't have to add this one to this one again. No. You just pick what is here, then you use it. This one too, you just pick what is here, then you use it. You don't add this one to it again. Okay. So that is what it means by what they say it has been recorded. All right. So the total that you have here is what? 28,800, right? So that is the share for share exchange. Then they also said there is a contingent consideration, for which the contingent consideration.
4,200.
Yes, so that one is measured at what? Fair value. Okay, 4,200. Please, the contingent consideration was a loan note. So it was a liability. So if by the time you are paying, the fair value come down, what do? You recognize a gain. So that is what happens. All right. So together, this is what we have. Then what comes next? NCI at acquisition, right?
Yeah.
And how much is that? So that one will be how much? How did you do it?
Well, I found the NCI percentage of the 8,000, the shares of
25,
and then I multiplied it by the 4.5.
Exactly. So that's that. So, and that gave you how much?
9,000.
9,000. All right, so that is that. So then you less what?
Fair
Fair
value.
Fair
value
value.
NCI at acquisition, which is your is two figure, and here is it. So you pick it 26,000. So how much will you get for your goodwill at acquisition?
16,000.
Is that how you did it when you were doing it alone? Or
Yes.
your eyes have
Yes.
been open to something? And the impairments, they told us that the goodwill of the group has been impaired.
Please,
Yes, please.
the NCI at the acquisition, the 9,000. Can you please throw a bit light on it for me, please?
Yes, please, you can ask your question now. Please ask your question again.
Yeah, what I'm saying is the NCI at acquisition, the 9,000. If you can explain a bit for me, how did you arrive at it?
Yeah, so the question said that this is it. The market value of Sanders shares, Picant and Sanders shares at the date of acquisition was this and this respectively.
Yeah.
Okay, so this is what you use it for. And when you come down, when you come here, you read here, it said that Picant policy is to value NCI at fair value at the date of acquisition. For this purpose, Sanders share price at that date is deemed to be a representative of the fair value of the shares that are held in the NCI. So that was the share price.
Yes.
This is it. So you have to calculate the number of shares. So if parent is 75, it means NCI will be what? 25% of the shares.
Okay.
So that is why you did 25% of the shares. All right. And this 8,000 is also found in the stated capital over here. This is it. Please, we use the 8,000 because here is 1. That's why I divided by 1. If you saw what I did. If it will be 0.5, I would have divided it by 0.5. Whatever is here, you divide it by this. Please, are you getting it now?
Yeah.
All right. And so we can continue with the impairment. They said that impairments were carried out on 31st March, which concluded that the value of the investment in Adler was not impaired. So there is no impairment in the associates, but there is impairment here for the goodwill for 3,800. Yes, Dennis. Yes, Dennis. Dennis, your hand is raised up. Let me hear from you. All right. Any other question?
Hello, sir.
Yes, please, I'm listening.
Yes, the impairment. When I read it, I wasn't getting to understand. I thought it's for the associates. So
No. Watch this. Watch this. Impairment test for 20. This was carried out. Was concluded, which concluded that the value of the investment in Adler was not impaired. That is the associate. But due to poor trading performance, consolidated goodwill was impaired. Please know that associate is not consolidated. Associate is not consolidated. Kindly know that. That is why they said consolidated goodwill, which means associate is not part. I hope you spend time watching the console videos, unless you owed money and you did not have access to it. Yes, some online students owed money, so they did not have access to it. All right. So that is that. That is that. Please, any other question? Any other question? So you have to keep these figures in mind. Don't forget, you will have to be sharing this with 75% and 25%. You can do that one down. All right. Yes, Dennis. Please, we just have a minute. You have to reconnect, okay? Dennis, I'm listening. Your hand is raised again. All right. So guys, when it goes off, you can reconnect so that we can move on while we wait for Dennis. If you have any question to, it says that please the share exchange. Okay, what about the share exchange? Dennis, I'm sure you owe money online. I'm sure Dennis owes money online. That is why